Employees are an important part of your growing business. But once you employ someone, you have opened yourself up to a whole host of liabilities and responsibilities you did not have before. This video is intended to give you a good understanding of what your employment obligations are and what issues to watch for. However, it is not intended to make you a payroll expert, and I never recommend that owners prepare their own payroll. There are too many details to attend to, and the risk is too high. First, understand that as an employer, you are under regulations from the federal government, your state government, and possibly regional agencies such as cities, townships, counties, or transit districts. Let's start with income tax withholdings. These taxes are paid by your employees, but you as the employer withhold them from their pay and remit them to the appropriate agency. Federal income tax, or FIT, is remitted to the Internal Revenue Service via their portal, eftps.gov, and is reported on the quarterly 941. These deposits are usually due each pay period, though a few small employers are monthly depositors. Each state differs, but most are deposited at each pay period, monthly or quarterly. Most states now have online portals for payment and reporting. Your state's Department of Taxation or Revenue will have the specific rules for withholding in your state. Local jurisdictions vary. Some have their own online portal. Some allow you to include the payments with your state filings. Now for FICA, or the Federal Insurance Contributions Act. It is comprised of Social Security and Medicare. These taxes are paid by you and your employees. You get to split the bill. These taxes fund our federal Social Security and Medicare programs. Social Security and Medicare are remitted to the federal government, the IRS, along with the federal income tax withholdings via eftps.gov. You may have heard of the Social Security wage base. This is the maximum amount of wages on which you will have to pay tax, and it is adjusted every year. You can see the rates and wage base here. Medicare applies to all wages. There is no wage base. And the employee is subject to an additional 0.9% in excess of $200,000 if a single filer or $250,000 if a joint filer. Now for unemployment taxes. Okay, there's no more splitting the bill with your employees. Unemployment taxes are all on you, the employer. These taxes fund the state and federal unemployment programs. Each state sets their own unemployment rates, and they will assign your business its own personal rate based on your industry and past employment experience. This rate usually ranges anywhere from 0.5% to 8% and is computed on the wage base. The wage base varies by state, but the most common is $7,000. This means you pay your rate times the first $7,000 of an employee's wage per year. So in the first quarter of the year, your taxes are usually the highest for the year, and they continue to decrease through quarter 4. Your state unemployment payments and reports are usually due quarterly, and most states now have online portals. Let's note a few trends in state unemployment. Because of budget issues, some states are expanding their wage bases to almost $35,000 per year. Also, states have started using unemployment reports to obtain lots of employment information. In the past, they just cared about name, social security number, and wages. Now they often want to know job titles, benefits information, and lots of other things for statistical purposes. The reports are getting more and more cumbersome. The federal unemployment wage base is $7,000. The rate is 6%, but if you are paying state unemployment tax, you receive a credit of up to 5.4%. So most employers pay FUTA at a rate of 0.6%. These payments are made to the IRS quarterly, again through eftps.gov, and are reported annually on Form 940. Oh, dear employer, you're not done yet. Workers' compensation insurance is regulated by each state and is used to reimburse employees for lost wages and medical expenses if injured on the job. It also prevents the employee from suing an employer for negligence. Every state's rules differ as to who must carry workers' compensation insurance, so check with the Department of Labor in your state for more information. Two major components affect your workers' compensation premiums: the employee's regular wages, not overtime, and the class of their job. For example, whether they work in construction, are in administration, or are sales. As you might guess, the more dangerous the profession, the higher the workers' compensation rate. Historically, you paid your workers' compensation premium to the insurer based on an estimate of your annual payroll. Then at year-end, the insurer would audit your payroll and adjust your premiums accordingly. However, pay-as-you-go policies are becoming more and more popular and make it much easier to manage cash flow. If you are an employer in New York, New Jersey, Rhode Island, California, or Hawaii, the state mandates that employees be covered under state disability insurance. SDI is intended to replace lost wages if an employee becomes disabled due to a non-work-related injury. In California and Rhode Island, it is a state-sponsored plan that is funded by the employee through payroll withholdings. In Hawaii and New York, you must provide disability insurance for the employee through a state-approved provider, or you may apply for approval to self-insure. In New Jersey, both the employee and employer contribute to the state-sponsored plan. Labor regulations cover such items as how quickly you must pay employees, overtime payment rules, child labor laws, and minimum wage requirements. The Federal Department of Labor sets minimum wage and labor standards, but your state may pass stricter regulations than required by the federal government. Every state has their variation on these laws, so check with your state's Department of Labor or Employment or Workforce Commission. In California, it's the Employment Development Department. Most offer an online employer's guide to educate you on all their provisions. As an employer, there are some things you should know. Who is eligible for overtime? After how many hours over what time period are they due overtime? Are lunch or breaks required, and how should they be paid? How quickly must employees be paid after the end of a pay period? And how quickly must a terminated employee be paid? Payroll and employment laws are complicated enough, but what happens when you add employees in other states? It's exhausting. Just remember these basics. Workers' compensation, unemployment, and withholding will be paid to the work state, not the employee's residence or the company's headquarters location. If an employee is reassigned to another state, you will move their workers' comp, unemployment, and withholding to the new state. Income tax is required to be withheld for the state where the employee works, but the employee may still owe income tax for his or her resident state as well. In states without reciprocal agreements, the employee will owe income tax in both the work state and the resident state. In this example, the employee works in New Jersey but lives in Pennsylvania. She will owe tax in both states, but will receive credit in Pennsylvania for taxes paid to New Jersey. But note, her tax problem is not yours. You are not obligated to withhold income tax for Pennsylvania if you are not conducting business there. You may withhold it as a courtesy to your employee, but it is not required. In states with reciprocal agreements, the employee will pay income tax only in the work state. In this example, an Iowa resident working in Illinois will pay only Illinois income tax. When it comes to sending employees into or hiring in another state, address the payroll tax issues before you start to avoid overpaying to either state. They don't usually make it easy to get it back. Payroll tax penalties are imposed by all agencies for late payments and late filing of reports. Don't worry yourself with the details, just remember these points. First, payroll tax penalties are expensive, particularly federal penalties. Second, state authorities will file liens on your business property for unpaid payroll taxes. Third, the most serious of all is the trust fund recovery penalty that can be imposed by the IRS. Trust fund taxes are those amounts withheld from employees. If unpaid, these taxes can be moved from a company liability to a personal liability for the responsible individual. Yes, that is usually the owner of the business. There is no way out of this penalty. The IRS will garnish future earnings of the individual to collect this penalty. So the best thing to remember is to always pay and file payroll taxes timely. And be warned, lots of seemingly unrelated things end up in the employer's lap. States require employers to garnish for child support. The IRS can require you to garnish for tax levies. All of these require you to withhold a certain amount from the employee's pay and remit it to the appropriate authority. When these garnishments are required, you will receive a letter from the agency with the amounts and instructions on how to remit. Don't forget, at year end, you need to provide your employees with W-2s by January 31st. Most payroll providers will do this for you, but will often charge an additional fee. You must have a valid Social Security number for each employee, or you can be subject to penalties. W-2s have also gotten more complicated over the years. More and more benefits information must be reported on the W-2s, including the cost of group term life insurance coverage, cost of employer-provided health coverage, elective deferrals under a 401k plan, etc. For example, there are 26 different codes for Box 12 alone. Hopefully, you are now aware of most of your responsibilities as an employer. To sum up, don't prepare your payroll in-house unless you can afford to hire a specialist, and it's always going to be cheaper to outsource. When budgeting for payroll, remember your payroll taxes will cost you an additional 10 to 12% over the employee's base pay. Make sure your payroll taxes are filed and paid timely, and don't ever use payroll taxes to help your cash flow. Make sure your outsourced payroll service is properly remitting payroll taxes by checking EFTPS.gov and the state portals for payments. And lastly, plan ahead when transferring employees to another state or opening up new locations. Get the employment regulations and payroll tax issues addressed before you start. So yes, being an employer is complicated, but it also helps your business grow. So be aware of the pitfalls and pick a good partner to help you with your payroll.